Started. Float money and all about mortgages. So to start, simply float money is simply an idea I came up with for a loan product because I think right now a lot of people are in float mode, right? And while the government has stepped up with a number of programs to help people. And while the banks are also helping with mortgage deferrals, there are people that are going to need cash to survive, to float, and to do other things as well. I had a call from somebody that is looking to renovate their house now. So good time to work to get to some of these projects. And also, and we'll talk about it more later, but there's going to be opportunities coming up where people are going to want to have access to cash, because I think it's going to take some time before we see the full fallout from the whole COVID-19, and then just a general mortgage update as well. So we're aiming to finish by 12 o'clock. As I said, feel free to jump in anytime with questions, and we'll bring Rena Mulca on board, mortgage broker, a lot of experience in private lending, commercial mortgages as well, for some discussion, and in case there's comments or questions where I might ask Rena to comment. COVID-19 impacts on the real estate market. This just came out, I think, the other day, and it was interesting. If you look at this, although it's really pretty early to make too many conclusions from this, but if you look at these statistics, you will see that across Canada, the prices of real estate really haven't fallen, with the exception of Toronto. Toronto's prices are down 11.8% from April, or in April from March. This is month over month statistics. Okay, so interesting, but again, I think it's too soon to really form any conclusions from this. But Toronto seems to be the only city where you really see changes. Not real numbers, according to Ernest. Okay, well, perhaps you can elaborate that on. If we have time, I'll ask you why, and upgrade you to participate later. Full impact will not be known for a while. Okay, so here's a comment from CIBC economists saying the housing market faces challenging in 12 to 18 months. Yeah, it's gonna take some time, right? There's going to be a spin-off effect, and let's face it, right now with the government and the banks buffering the effects of the COVID-19, there is it's going to take some time. And I saw something in an article that CMHC is saying that they would support an additional 6 months, okay, an additional 6 months of mortgage deferrals, which is interesting. But I think I'm not 100% convinced of that yet. And don't forget that CMHC, that's only on insured mortgages. So I don't know what position the bank will take, but you got to figure if somebody's going to be defaulting on their mortgage, let's say they've lost their job and they cannot be reemployed, you know, it's going to take a number of months. I think after the first 6 month deferral, it's not like the banks are going to immediately start taking action against everyone. They're going to have to go slow. Gerard Buckley, welcome. Good to see you. Okay. So I think that we are likely to see far more significant impacts in the commercial space. This is my opinion. I don't think that's rocket science. Retail was having a difficult time before. So sadly for many, this is going to be the nail in the coffin. Of course, office is going to suffer too, as people start to adjust more and more from working from home. And companies are saying, why spend all of this money on real estate if people are working from home. Um, Home Trust is one of our lenders that I happen to respect very much, an alternative lender, and they're talking about 5 to 10% year reduction in prices of real estate. They're operating most in the Toronto area, so that's uh, that's what I think they're talking about. They're saying the impact in outlying areas will be greater than what they are in Toronto in terms of price reductions. Appraisers have an interesting situation because there's going to be, if there isn't a lot of activity in the market, it's hard to find comparables to come up with their appraisal reports. And then if they start looking at older data, then they have to include a price drop or a valuation reduction due to a time adjustment factor. So one or two of the appraisals that I've spoken with commented, and that can also have in of itself a negative impact. Um, okay, so how many people took advantage of the deferrals? Approximately 10% of mortgage holders across Canada, or more than 10%. This is what I was mentioning before, where CMHC has given lenders the flex, apparently. But this again needs to be confirmed. But that's interesting. If they're going to give people an additional 6 months, I mean, think about if you're a private lender with a second mortgage behind a bank mortgage, and the first mortgage hasn't been paid in a year. If that ends up being the ultimate result, that's significant. And on top of that, prices could come down. So, uh, so private mortgage lenders have to be careful for that reason, and we'll get into that a little bit more. Um, to start, what drives rates? Of course, there's two different kinds of rates, right? You have your variable mortgage rates and you have your fixed mortgage rates. So with variable mortgage rates, those are driven by changes in the Bank of Canada overnight lending rate. In March, the Bank of Canada dropped rates 1.5%, three times, a half a point, three times, for a total of 1.5%. And the overnight Bank of Canada rate is now 0.25%. The prime rate with pretty much all lenders is based on that overnight rate, and the prime has therefore dropped at almost all lenders by 1.5%. Prime rate is now 2.45%. But what has happened is that despite the reductions, the discount that the banks were offering off the prime rate has reduced. And the reason for that, I believe, is that they're kind of eating up some of that savings or reduction, because they themselves are concerned about potential losses and impacts on profitability when the real estate, when the economy slows down. It's going to impact the number of new loans. It's going to impact the number of defaults. And that's why, despite lower rates and lower pressure on rates, they had actually, at first, they dropped the rates and then they pushed the rates back up. And now they're starting to temper back down slowly a little bit. With respect to fixed rates are impacted from the bond market. So what happens is that when people feel lack of confidence in the stock market because of a negative economic situation, they pull their money out of the stock market, they put it into the bond market. Bond prices go up as a result of the demand for bonds. The yields on the bonds go down, and therefore fixed rates go down. So both variable and fixed rates trend downward typically. But in this unique case, they went down and then they were going back up again. So I talked about, so current 5-year variable rates starting at approximately 2.25%. That's for an insured mortgage. and 5-year fixed rates starting at approximately 2.44%. Again, that's for an insured mortgage. So rates are certainly attractive. I'm just going to take a quick look to see if there's any comments or questions. Tell them that they can. If people are new to Zoom, you can tell them that they can change the portion of their screen that shows the presentation and the panelists' faces. So you can change your view so that you can see me as well as the presentation, or have different proportions. Okay, thanks, Joel. Appreciate your your feedback, I should say. Okay, so moving on. I talked about why rates were down and then up, and now they're easing back down again because the bank was swallowing up some of that reductions. Impacts on institutional lending. Well, this was supposed to come out one line at a time, but anyway, no big deal. So generally, we see a reduction in the loan to values by approximately 5 to 10%. More current income documents are required. TD says 14 days now instead of 60 days, just as an example. And even though they have said, some of the lenders have published that they're not going to re-verify income. So if you've lost your job and you have a mortgage approval on a property that you're looking to close, from my experience anyway, most of the lenders will do the verbal income verification just prior to the closing. So you could get stuck if you have lost your job. I would talk to the bank about that so you don't get shocked at the last minute if you have lost your job, or to your mortgage broker. They're also saying they're more flexible and doing a case by case sort of assessment. So, you know, if you're very likely to get rehired, they may take that into account depending on the type of job you've had. You know, what type of business are you in? Has your business been affected by the COVID-19? Okay. And I've also seen a couple of mortgage. I was working on this last week. For an example, Trenton and Woodstock, some of the lenders are pulling back. They're saying, oh, we're not going to lend in that town. Or we would have, but we're not going to. Or they're reducing the loan to value. So instead of, let's say, 75% max, maybe they're saying now we're going to be looking at 65% or something like that. Property investors looking to refinance, one of the questions that has come up is, what's the portfolio looking like, and are all the tenants paying so far? Because that's going to be considered. So if you're looking to refinance, it's important that your tenants are paying for us to be able to use that income. Another thing that came up, I'll mention, I advised somebody, I said, you know, maybe you should consider taking the deferral, the mortgage deferral opportunity on your investment properties. And I think that it's probably, if you plan on refinancing in the near future, probably better that you don't do that. I don't think it's going to look very good if you have taken a deferral and now you're looking to refinance, because taking the deferral suggests that you yourself are having a challenge. So if you're the person who I made that advice to, I think you probably ignored my advice, which may be a good thing in the end. Impacts, at least I hope so, impacts on private lending. At higher loan to values, private lenders have faced even more shock, I think, than the institutions. Most of the institutions are still out there marketing day by day, day to day, that they're actively looking for business. Whereas some of the private lenders have literally stopped lending. They just wanted to evaluate the situation. In my opinion, especially at lower loan to values, mortgages are still a great place to invest your money. I mean, how much can the market drop by. Notwithstanding my earlier comments about long-term impacts on the market, you got to think of overall, this GTA market has been so strong with all of the immigration, and people just love to have their money in real estate. And Toronto really is a world-class city. So, as a result, we still have lenders that are advertising, if you can believe it, 85% financing and 85% second mortgages. I'm sure their criteria is going to be pretty strict, mind you. But if you really need the money, then in many cases we can still get it for you. It might be expensive, but that's the way it goes sometimes. Lenders that were out for a short time are back online. Variety of private lenders, mix included, mortgage investment corporations were out. Now they're back. As I said, private money is still available. Lenders are asking in some cases for the interest to be prepaid. I mean, it'll help a little bit to secure their position, not necessarily in a massive way, but it will help somewhat. Remember that and this is my comment earlier, if you're in second position and a bank is deferring mortgage payments, your position is being exposed, okay? And add to that a possible reduction in values. No wonder some private lenders are concerned. Float money, I mentioned simply, if you need money to stay afloat, it's just another form of a private loan with reduced criteria. The assumption is that maybe you've lost your job, but maybe not. I've been working on a line of credits for a couple of very strong borrowers in the last couple of weeks. And good time to get access to that money if you want to be able to take action in the not too distant future when there are opportunities. So get that line of credit set up as well. So whether you're in a strong position or not in a very strong position, having access to cash could be very valuable. Again, open loan that you can pay back at any time is a plus in that kind of a situation. And maybe your needs could be short-term as well. Whatever your needs are, okay, we can help you with it. But that was just the concept of the float money. Owner-occupied residential. So this is just some getting to basics, more general comments. Let me see if there's any other questions right now. Do I think the rate will, Tina says, do you think the rate will be 0 or negative? Well, it's possible that the Bank of Canada drops the rate from 0.25% to 0 or to a negative rate. I mean, I suppose it's possible. I don't think that's very likely to happen. Rates are quite low right now, so it's possible. I don't know whether or not that's going to happen. I know that that people are saying the effects on the economy are more than we even know at this time. So only time will tell to see how quickly people get back to work and how quickly the economy rebounds. Okay, thanks for that question, Tina. Thank you. Okay, so basics in terms of mortgages. CMHC insured mortgage with as little as 5% down on the first $500,000, and then after the first 500, you have to have 10% on the remaining balance. Okay, that's basic owner-occupied property. You can have up to 2 owner-occupied properties that are CMHC insured. If the purchase is over $1 million, if the mortgage is over $1 million, it cannot be CMHC insured. So you'll need to have 20% down in that case. Okay. And here are the insurance premiums that are added to the mortgages. All right. So whenever you have less than 20% down, these are the insurance premiums that are added. They're capitalized onto the mortgage so that they're not part of your closing costs. You do have to pay HST on them as part of your closing costs, but the premiums themselves are normally capitalized unless you want to pay them. You can pay them if you wish up front. But usually the purpose of having a CMHC insured mortgage is because you want to reduce your outlay, your down payment, upfront costs. Owner-occupied residential properties continued. So besides the down payment, what else are lenders looking for? Well, first of all, they're looking for income. So as a rule of thumb, the maximum mortgage that you're going to qualify for is 4 or 5 times your income. So if you make $100,000 a year, you might qualify for a mortgage of between $400,000 and $500,000. Okay, that's just a rule of thumb. It doesn't account for rental income. If it's a rental property, it doesn't necessarily consider if you have other debts. And if it's a condo, you have maintenance. But as a general rule of thumb, that's kind of a quick calculation that I do. Okay, let's see if there's any other comments, questions that we should. Okay. All right. Well, let me continue with this slide, and then we'll talk about some of that questions. Self-employed. Okay, so the 4 to 5 times income if you're salary, generally speaking, they want a job letter and a pay stub. If you are self-employed, they're looking for 2 years tax returns and notices of assessments. Okay, alternative lenders, which I do a lot of work in that area with self-employed. If they 2 years tax returns and notice of assessments, if they don't have them, or if they're not going to yield a positive result, let's say because they have a lot of tax write-offs and therefore the net income, the bottom line income, doesn't get them what they want. With our alternative lenders that we use, and some people call them B lenders. I don't like to use the term B lenders because we deal with a lot of very strong borrowers who we take to these alternative lenders. They charge a little bit more, but they don't ask for notices of assessments or tax returns. They just base it on bank statements or commission statements. They work off of the top line instead of the bottom line, okay? And of course, the next thing other than income is credit, right? And for credit, you need to have at least 2 or more trade lines like credit card, car loan, line of credit, and ideally a 2-year history. Okay, if you don't have that, talk to us. We can probably still help if the other factors about your mortgage application are strong. But this is typically, if you want to qualify for the best financing out there for bank financing, this is typically what the banks are looking for as a minimum. Okay, again, alternative solutions for those with credit issues, and even for those who are new to Canada, let's say, and don't have the credit history, we have solutions with banks for as little as 5% or 10% down. We can show alternative forms of credit worthiness, looking at utility bills or possibly a credit report or letter from a bank in another country, depending on the country as well. Let's take a look at some of the questions we have here. This is great. We have 49 participants still, so thank you all for joining. That's great. Okay, Sarah Daniel. Hi, Sarah. Anonymous attendee. Some people might ask for a mortgage deferral not because they need it, but because they might wish to invest the funds in the short term. So do you not recommend this type of use of deferred mortgage payments? Well, you know what? That's a really interesting question. And the way I would answer is that, wow, how do I answer that question? It's not really for that purpose, right? It's not really for that purpose. So if you're avoiding paying your mortgage and you end up getting stung by it in some way later, you can't be surprised, is all I can say, right? It's like parking in a handicap spot. You know, let's say there's 5 handicap spots and you're like running into the supermarket late at night and you think, you know, there's no the chances are that I'm taking up a spot that somebody, a handicapped person, is going to need is very low. But if you do get caught and you get a ticket, you can't really complain about it, right? So, you know, it's possible that the credit reporting agencies make mistakes, or that the bank doesn't report it properly. If it hurts your credit, um, and then, you know, you can be complaining to your blue in the face that it shouldn't have impacted your credit. But what are you going to do? So I would say, if you don't really need it, don't take it. That would be my advice. Do you think cottage properties will go down and people can't afford 2 properties? Would you use a line of credit towards the closing costs instead of getting a mortgage? Okay, well, property cottages, I would say cottage properties may well be affected more. I mean, it's usually, you know, recreational thing. And I think that properties that are like, you know, very high price point, like high luxury, you know, very luxurious properties and recreational properties, I think that, yes, I think they could be affected more significantly than properties where somebody just, you know, needs a place to live, right? So properties where, you know, the average person can afford to live, those are your best bet from an investment standpoint, and also in terms of probability that the prices are not going to go down much. Okay, so that's my comment on that. Would I recommend using a line of credit towards the closing costs um, instead of getting a mortgage? I'm not quite. Oh, that's Deborah. Hi, Deborah. Um, well, I mean, it really depends on your situation, on what you're doing. So if you're investing money and you can earn a higher return on your money, then borrow the money or get a line of credit. Doesn't really matter, and you can write off the expense. Um, Keep enough cash handy to take advantages of opportunities and to make sure you've got what you need to live. It depends on your situation. Okay, self-employed. Again, so I mentioned before with our alternative lenders, just going to do a time check here. With our alternative lenders, yeah, bank statements, commission statements instead of 2 years tax returns, that helps a lot of people out. And up to 80% loan to value, okay, because these are not insured. I lost sound temporarily. Oh, can you hear me now? Can you hear me now? I hope so. Check, check, check. 1, 2. Hopefully you can hear me. Okay, so up to 80%. Let me know if you can hear me, guys. Hopefully you can. Somebody comment. Yes, I can. Okay, thank you, Teresa. Okay, so up to 80%, and we're going to bring Rena on in about 10 more minutes. We'll have a discussion. You can ask some more questions. Up to 80% loan to value, because if you want more than 80% or your down payments less than 20%, it has to be CMHC insured or Genworth insured, and their rules and regulations are pretty, you know, more or less the same wherever you go. That's been my experience, but lending can be far more flexible if you have at least more than 20% down, or you're doing a refinance where you have 80% equity in the property. You pay a little higher for the alternative lenders. As an example, you pay 4% rather than 3%. Could be higher, should be lower. They'll put it on a longer amortization, 30 years rather than 25. So it makes it more affordable compared to a 25-year. As I said before, big help. And I'm moving along quickly because there's one or two things that I really want to get to with respect to reverse mortgages and such, because those are very popular now. And I've got an interesting model here, which I think is worth looking at. Right. So if you're self-employed and you're one of these people that has like a ton of write-offs and your net income is very low, and it's not for me to judge whether those write-offs are legitimate or not. Okay, so I'm not encouraging anybody, but that's just the reality. Is that how some people they run their business? And if they reporting very little, they can get a lot more mileage with one of our alternative lenders if we're not asking for tax returns and notices of assessments. Investment properties, as I said, at least 20% down. And now, in some cases, could be more, 25% or 30% down. If you want to buy properties and you don't have the cash, but you have equity in properties, we can refinance those properties, take out equity so that you can purchase more properties, and we can use rental income to help you qualify for some of these rentals. The banks are very strict on how they treat rental income. The lenders that we often deal with, these alternative lenders, are far more flexible and can help you get more mileage. We have people we're working with who have upwards of 10 properties who have maxed out with the bank. Okay. I wanted to talk a little bit about reverse mortgages because they're very popular now. You have to be at least 55 years of age. And if you're a couple, we use the younger person. And the loan amount depends largely on the value of the property and your age. So the older you are, the more money the lender is willing to give you. Rates vary between 4 and 6%. We've got two lenders who are working in this area, and one of them is a little more conservative. They don't lend as much money. Their rates are better. The other one, if you want a little bit more money, their rates are higher. So altogether between 4 and 6%. You can borrow the money for any purpose, a gift to an adult child, or for travel, to make improvements to your house. And the thing, of course, the thing about the reverse mortgage is that the interest accrues. Okay, so you don't have to make interest or principal payments on the mortgage. So if you're happy where you're living and you want to stay there and you want to relieve some cash flow issues or access some cash, a reverse mortgage is a good solution. You must still pay your property taxes and property insurance, of course. Some people worry about what will happen. Are they going to take my house? No, they're not going to take your house. As long as you pay your property taxes and your property insurance, you will not be in default in the mortgage, and you can reside in the house as long as you live. Okay, so so it's a good solution for some people. Oh, last point, up to a sixplex. That's interesting. Thing that I learned a little while ago, so that a lot of people don't know. You can get into a multiplex property and also then enjoy the rental income from some of the other units having a reverse mortgage. So I actually crunched these figures this morning because somebody asked me, somebody said, look, we're worried if we get a reverse mortgage, what's going to happen? All our equity is going to erode. So I just did up this little spreadsheet. This shows you for a 70-year-old person, assuming a property value of approximately $800K, a property in the Toronto area. I don't think it'll make that much difference if it's outside of Toronto. It assumes a single family dwelling. I'm using 6% annual interest, which is pretty much the worst case right now. All the interest accrues, so assumes you don't make any mortgage payments. What happens over 15 years? Okay, well, we're also going to assume that the property values go up. Some of the real estate agents, real estate professionals will be able to comment They would know better. But I think if you look at the last 15 years, probably on average, prices in the GTA have gone up by around 6% per year. I'm going to take a wild guess. Robert, Ernest, if you guys know better, you can correct me. But certainly 3% per year is what we're going to assume for this case. We're going to assume that your property value increases 3% per year, while the mortgage amount grows at a rate of 6% per year. And of course, it's compound interest. So you can see current situation is on the left side or the center column. And on the right, you see what happens in 15 years. Your house is worth over $1.2 million. Total mortgage owing is your initial $350 plus $500,000 in accrued interest. The remaining equity in the home is almost the same as it is today. It's around 400,000 versus 450. Okay, so your equity in the home does not necessarily erode. I'm going to take a look. Don Jones, you can hear us. Thank you. Ernest, yes, good. We can hear you. Thank you for, okay, very good. LTV on a reverse mortgage. Navtaj, my brother from another mother. Navtaj, good question. The amount of money you're going to get, it starts at around, like for 55 years old, I'm going to say around, like it's low. It's like probably around 20, 25% loan to value, say between 20 and 30. And then, you know, as you get older, let's say you're 90 years old, you might be up around 55 or 55% loan to value, maybe a little higher or thereabouts. Okay, so you can see how the age is definitely a key factor. Okay, so time check. Moving along, we're going to bring Rena on in a couple minutes. Let's see. Okay, I mentioned newcomers. 5 to 10% down. Okay. Purchase plus improvements. That's a good program whereby if you need to make improvements to a house, great in Toronto is a lot of older houses. So you can buy it and you can arrange, set it up so that the lender actually advances, I think it's up to 10% of the value of the house, not more than $40,000 towards renovations. So you go in and they agree to lend a certain amount. You have to do the work yourself. Once you complete it, additional funds are released to you. So that's part of a purchase plus improvements program. Somebody's commenting here on Home Trust, Maziar. You know of any non-income qualifier program with any lenders? So most lenders are looking for income nowadays. There are a couple of programs out there, not that many based on net worth. Okay, so if you have clients like that, or you are in need of a loan like that, it is possible to do in some cases up to 50% loan to value, in other cases up to 65 with one lender. If you have 2 or 3 years worth of principal interest in taxes in a savings, that I believe that is still possible. So if you have that need, let me know. Okay. Construction mortgages is a mortgage that's advanced in multiple draws. Usually you get a first advance on the land, and then subsequent advances come in stages as you progress on the project. Commercial mixed use properties, again, depends on what it is. If we say multi-residential, 5 units and up, that is still a very desirable asset class, and that's something that you can get CMHC insurance on and purchase with up to 85% financing. Okay. Mixed use assumes a combination of residential and commercial, of course. Usually you're looking at between 65 and 75% max loan to value on commercial and or mixed use. If you bought a property, you lost your you lost your job and now you don't qualify, well, you better talk to the lender because you don't want to find that out at the last minute. And you might be able to get money from a private lender. So talk to a mortgage broker as well. Okay, and we'll talk about what it's like to work with David, me as a client, and if you're a mortgage agent, we'll talk about that a little bit later. Let me find Rena right now, and we're going to bring my good friend Rena Malka on. I'm promoting her to panelist. Rena, if you would just, we're going to activate your, there we are. Rena, how are you?
Good, how are you?
Good, good. Welcome to our All About Mortgage webinar. How are things going in your world, Rena?
Well, I'm, at home self-isolating and, working, trying to, get a little exercise here and there. Business is busy. A lot of people are having difficulty getting, money through the traditional sources because of the pandemic. A lot of lenders are being more conservative and worrying about if people will keep their jobs or if tenants will pay the rent and all those things. So a lot of private lending going on.
Yeah.
And that's about it. And hoping this is going to end sometime soon, but it doesn't look that way.
Well, I've over the years, I would go to you once in a while, on a. I know you always say, send me some easy deals once in a while, but I'm sticking to my habits. So, what have you been seeing in the world of private? I mean, I know you get some very interesting mortgage applications across your desk from all over the province,
Sure.
in rural areas, from builders. I mean, what do you see happening in private mortgages, in construction mortgages, and so on?
Sure. Okay, well, for example, we just did a deal as an A deal, 5 years, 2.99. It was a student residence in Kingston, but it basically looked like a single family dwelling. And there was like a separate apartment in the basement and a separate apartment on the main floor. So we just had whatever 3 or 4 students who were in the basement sign one lease, like one apartment, and the main floors just sign another lease, like another apartment. And so we were able to do it as a residential deal. So, and they had already been turned down by TD and Scotia. So sometimes, we can make things work. Another one that it's very tight as far as the TDS was like 45%, but we were also able to get it with an A lender at 2.99, of which all of the money except $1 was on a floating rate, a variable rate at 3.05%, which was really good. So we can do some of those types of deals. Just depends on, sometimes we get lucky and get a good lender on them. As far as like private deals, right now I'm in Forest Hill, which is in Toronto. A builder just completed 2 houses. They're worth around $3.5 million each. And we're giving them 62% of the value at 6.25% private. And the fees like on that was like 2.5%. And the first 6 months we had a penalty of 2 months interest. They're almost like, they're like 95% completed on the houses. They're almost finished. They're going to market them for much more than what the appraiser said they're worth. But anyways, that's a matter of opinion. Who knows what the values are in this environment right now on an expensive home like that. But, and then after 6 months, it's open with no penalty. That's an example of what we just did. Another one similar to that was a bed and breakfast, which they've been operating for 15 years in downtown Toronto. But as you can imagine, now there's no clients staying at bed and breakfast. So we also did that private at similar rates than that I mentioned on the previous deal. But what we did there, because they can't afford the payments, we gave them a 2-year term, and we took half of the interest paid up front, and then they only have to make a half a monthly payment, which was something they could afford. So that was a little bit of a creative way to make it affordable to them.
Rena, what are you seeing like as we start to move outside of Toronto? And what do you foresee? Like, do you agree with some of my comments about some of the smaller towns potentially being more volatile?
You mean with respect to values?
Yeah.
Well, nobody really knows. And actually, one of the appraisals we just had done on a fiveplex on Avenue Road, they actually put a caveat in the appraisal report saying this is the value today, but we're not responsible if it goes down due to the COVID situation. So nobody really knows what's going to happen at all. I guess it all depends how long this lasts. And, could be that when things do ever get back to some kind of normal, there will be such a pent up demand that prices could actually go up again. So nobody really knows. But we're not really finding the values going down that much. For example, that bed and breakfast, which is in downtown Toronto, last year it appraised for $2 million. But then throughout the year, up until the beginning of March, it went up probably till about 2.2 million. But then now they put it back to 2 million and 20. So it still was 20,000 more than a year ago, but it still went down compared to what it was, recently before the COVID situation came into effect.
How do you even appraise a bed and breakfast? Like, I mean, like there's got to be almost no
We
comparable.
just appraised it as a house.
Okay.
It looks like a house. They've just operated it as a bed and breakfast. And the people, the husband and wife are living in it. So we just said that's the value as a house. So we don't care if it's a bed and breakfast or not.
Okay. So, well, as a bed and breakfast, it's probably worth.
They have zero income right now. I think they have one long-term tenant, and so they have a little bit of income.
Okay.
So land is almost impossible. We have a little bit of money for land, but we have lots of money for construction. And construction is in major urban centers. We're getting 8.5, 8.25, 8.5, and with lenders' fees, the fees are around 2.5 to 3 on a first, and like 9.5 on a second construction. So, but then the builder or the client has to have enough money to, cover from the loan amount. I don't know how many people are familiar with construction, but first of all, there's going to be 10% held back for the Construction Lien Act. So 10% of the money, you don't even see it until 60 days after the property's finished. So you have to have money to put in. And also I could go through the formulas of how advances work or whatever if you want after, because there's two ways we do advances on construction financing, because I know you mentioned you might want me to talk a bit about construction financing.
Okay, well, we've got a couple of questions though. So
Okay.
Why don't we tackle those? First of all, Adele Durango's asking for your contact information. So,
Okay, best number is 647-838-5061. We're all working from home, so that's my cell, 647-838-5061.
Adele, Rena's my Facebook friend too. So if you're friends with me on Facebook, you can also contact her through me or through Facebook. Ernest, okay, we'll come back to you, Ernest. Sam Sony Edom, can you?
Yes, if anybody calls me, by the way, please mention that you saw me on David's show here. So I'd like to make sure he gets the credit.
Thank you, Rena.
That he deserves.
Thank you very much. Sam Edom is asking, can you add an equity line of credit provision to an existing mortgage?
Yes, we can. Like David said, he has a very good relationship with Home Trust. They do that. They have what they call an equity line Visa, which is registered as like a line of credit second mortgage. You can use it as a line of credit and as a Visa card.
Right. Okay, so that's definitely possible. Ernest is asking, where do you see commercial mortgages going?
Okay, well, right now, we do have some money institutionally, for sure, multifamily, especially if we do it CMHC, or industrial, especially where there's essential businesses still in there, manufacturing or, using it for storage, maybe storage of masks, who knows, whatever. But retail is, you'd have to do it privately and probably have some prepayment of interest, since like 80% of the stores are closed. They're not essential. And even the ones that are closed, they are paying the rent, but we don't know, how long this will last, if they'll continue paying the rent. And there we're going to ask for the borrower to provide bank statements for the past 3 months, like to show that on April and May 1st, at least, that the payments of rent were made. And I guess office buildings also are in the same boat as the retail. So industrial is still good for institution. And residential rental. Otherwise, we're probably going to have to go private.
Right. I guess unless it's something that hasn't been impacted, like a grocery store.
Right, but if it's a yeah, that's true. But if it's a plaza and there's a grocery store, but all the other stores, and maybe there's a Shoppers Drug Mart, or
and an LCB and an LCBO.
No CBO, then if they have all the essential tenants, they're in good luck. But not every. But if there's some nail salons and whatever else there,
right,
and offices, so they, some things are definitely going to be closed in the plaza. Okay. So it does affect the situation as to what financing they can get right now.
Okay. Sarah Daniel is interested to learn about construction financing. So can you talk to us a little bit about construction financing, Rena?
Mm-hmm. So we can do construction financing for either like a single family custom home, or like a little infill townhouse project, or apartment buildings. Could be low rise, mid rise, high rise, or commercial. Like right now, the financing was arranged a lot before the COVID situation, but advances are taking place on financing that was arranged for a retail plaza in Guelph that is pretty much pre-leased with essential tenants. So hopefully that's good by the time they build it and the tenants go in, and everything should be okay. But on residential, if it's a single family dwelling, how the lender calculates the advances is, first of all, they would have an appraisal done of what the land value is, and also what the completed value will be according to the drawings. They can see what's going to be built and the budget. And then usually you can get 65% of the completed value, which might be 80 or 85% of the cost of the land, hard and soft costs. And the soft costs are including all the professional fees that you might have, architect, engineers, or mortgage brokers, appraisers, legals, and also the interest that you expect to pay during the term of the loan. And some lenders also hold back that interest as well. They call it an interest reserve, or some will let you just pay it out of each advance. So the appraiser will, anytime you want an advance, the appraiser will come and they'll have this tick sheet. It's called a progress inspection report. And they'll say what percent complete you are. So it'll say something like, excavation, foundation, backfill, all that together, it might be like 14% complete. So whatever is remaining of the loan amount after they've given the land advance, you'll get 14% of that, minus the 10% lien holdback. And then that's the way it goes, continuing on. So it goes by percentage complete. But if you're doing a larger project, instead of percentage complete, they use what's called a cost to complete formula. And for that, you need a cost consultant. Companies like Pelican, Intrepid, and Altus. So they look at the drawings and they come up with a budget, and which might be higher or lower than your budget. And then they are the ones who do the progress inspection report, and they say the dollar value of the work that's done and the cost to complete. And the lender will always hold back the cost to complete. So theoretically, if God forbid anything happened to the client or the builder, they're supposed to have enough money in the kitty to finish the project. So if we have a specific project, we could show you how the advances would work, but you can have the advances anytime you want. So we really don't know what advance you're going to get at any given time, but we could say, well, if you want to do it at, 3 advances at the roof stage, when you're enclosed, or drywall, electrical, plumbing stage, and completion on a house, we could estimate for you approximately what draws you'll get. And you pay interest only normally on the amount of money that you've received. But there are a couple of lenders who advance the full funds into their lawyer's trust account, and they expect you to pay interest on the entire loan amount, even though you haven't received the money, which I don't particularly like that, but a couple lenders do that. So you have to watch out for that. Make sure you're paying interest only on the amount advanced. If there's any other specific question about construction financing, I could answer that.
Good comments. Thank you, Rena. Ernest is asking, is there money from multi-res? I remember 2 weeks ago you mentioned you got somebody financing on an apartment building at like under 2%, something like that.
Yes. Um, the rates, if it's a larger deal, and if we do it CMHC insured, the rates are less than 2%. I've never in my entire career have seen rates that are in the ones. But we did do 4 million on an apartment building, and they got 1.64% for 5 years. They could have also had a 10-year term, but because they were older and they thought that in 5 years they probably want to divest themselves of the assets, so they didn't want to take a longer term. So even a 10-year term could be under 2%. So, but the only thing with CMHC is that they are taking a long time to approve deals. So they're okay on a refinance if you have time, if you start like 3 months ahead of time. And if you do have an apartment building, like this is the time to refinance because the rates have never been lower. But you have to have time. But if it's a purchase, no seller is going to want to give you a financing condition for 2 or 3 months. So then what a lot of purchasers are doing, it's even hard to find apartment buildings to buy, is they'll close with a private and then apply for the CMHC. So even though it's costing a little bit more for the first 3 months, in the long run, there's a great savings.
Rena, do you find that there's much difference dealing from one lender to another when it comes to financing, a 5+ unit apartment building? I mean, like we talked about recently how even though CMHC says they're going to finance up to 85%, by the time they finish doing their own evaluations, it often comes up to much less. But I mean, can that vary from how one lender looks at it to another? Or do you think it's all going to be the same maximum loan to value at the end of the day?
Well, CMHC, they have a formula, just like in residential, you have GDS, TDS, and in commercial or apartment buildings, we have what's called a debt coverage ratio. So on a 5-year term, their debt coverage ratio is 1.3, and on a 10-year term, 1.2. So what that means is, there in the 5-year term, that means there's $1.30 available for every dollar of mortgage payment. That $1.30 is after taking off a factor for vacancy and bad debt, and management, maintenance, and all those things. So those are and then see, that's for the debt coverage ratio, and also as far as the loan ratio goes, that depends on what value they come up with. So they use what's called a cap rate to determine the value. They take that same net income and divide it by whatever 5% or whatever they believe the cap rate is. So usually, instead of 85%, their opinion of value will really give you about 75%. But what I like to do, even though they don't require an appraisal report, they require environmental but not appraisal, they charge $150 per unit application fee, which includes their own appraisal. But I still recommend getting our own appraisal, because then I have the appraiser give us a schedule of comparable vacancy rates, because if they wanted to use 3 and I could prove it's only 2% vacancy, that increases the net income, which helps with the debt coverage ratio and with the value. And also a schedule of comparable cap rates. Again, so we have ammunition to argue with them. So the lower the cap rate, the higher the value. So we're going to try to convince them to use a lower cap rate. But we need to have the ammunition and the evidence to be able to argue with them. And we've been quite successful in getting, the maximum loan amount, as long as that debt coverage ratio is met. So if the rents are below market, it could hurt the property.
Rena, what if it's not CMHC insured? What's the maximum loan to value, and what does the pricing usually look like?
Well, it used to be 75%, but again, as long as the debt coverage ratio is sufficient to support 75%. But now a lot of lenders are not going to do any conventional apartment buildings. They're only doing them if they're CMHC insured. That's why if it's a purchase, you have to get a private mortgage till you can get a CMHC insured one.
Okay, interesting. There's a question from, oh, by the way, a couple of people have asked for your phone number. I put it in the comments, guys. Check the comments. I put both my phone number there and also Rena's phone number.
And may I mention again, if you call me to say you saw me on this program, because I want to make sure that David is aware of it and gets the credit he deserves.
Thank you, Rena. Thank you very much. Question from Chilla Ziriak. Can you do mortgage on a co-owned multiplex? Each unit is owned separately. Well, that's an interesting question.
That's a co-ownership. Um, I don't know if there's any lenders who would do that right now. Like there's another kind of ownership called co-op, which there's only like a couple of credit unions that do them, and then there's a couple private lenders that do them, because you can't put a regular mortgage on it. Like as a co-owner, you own shares of the whole development. So what the lender gets as security is an assignment of those shares. Sorry.
Calls are coming in already.
No, that's my brother. But he doesn't know. I should have put it on silent. Let me put it on silent so that doesn't happen again. There we go. Silent. Okay. Yeah. So they're harder to do. There's very limited funds because the recourse you have with the shares of the corporation it's not as flexible. If you have to sell the property, it's harder to sell shares of a co-op or a co-ownership than to actually sell a property that you could have title to the real estate. I don't know in today's market what they would be. And I'm assuming when you say individual ownership, is this like a resort area or what is it?
I don't know. That's
Usually
all.
that's done on a resort area, the co-ownership, and they have like their own cabin. I honestly can't answer that question, to be fair.
Okay, fair enough. What do you think will be harder to fund, retail or office? That's a question from Ernest.
Probably retail, but office is right up there too. Like, a lot of offices are closed. Even though mortgage brokers were considered to be an essential business, I could be at the office. But, most people are electing to stay from home. Their offices are closed, or they might just have like one secretary there. A lot of businesses, their businesses down, and not able to pay the rent.
Yeah, I think and even in terms of retail, it's going to vary significantly, as we were discussing before, depending on the tenant profile, right? Like I heard Gold's Gym shut down, right? I don't know how many locations they have. So if you've got a gym, you have a problem. Whereas if you have a grocery store and an LCBO, it could be very significantly different.
That's true, but it's still not going to have 100% of the tenants and occupants like open.
Right.
Yeah, so it's good to have some, and restaurants are just doing takeout. I don't know how long, they can survive doing that. So it is difficult. So, and some tenants are still paying the rent, even though they still have to pay the rent, even if they're closed, unless they're going to go out of business.
Well, the government came out with a program, right, to help landlords offer some kind of a reduction, and then the government's kicking in some money, I think.
Well, the problem with that is that the landlord has to agree to participate. So my understanding is the tenant would pay 25%, the government would pay 50%, and the landlord has to kick in 25%. But if it's all up to the landlord. If they say no, they don't want to participate, then too bad for the tenants.
Yeah,
it's not like a guaranteed thing. It's optional to the landlord.
It's optional to the landlord, but if you're a landlord and you have tenants who are not paying, and you know that they are unable to conduct any business at this time, you might choose to take a 25% reduction rather than get nothing. There was a follow-up question on the construction financing, saying, thanks for the overview. What are the terms of the repayment of the loan?
Well, while the funds are being advanced, you pay, as I mentioned, interest only on the amount advanced. So when you get your next draw, whatever number of days you had that amount of money, they'll deduct the interest from the next draw, is what they normally do, until the funds are fully advanced. Once the funds are fully advanced, then you just have to pay interest on the full amount, interest only monthly. And because it's usually at a higher rate for a private construction mortgage, and when the property's completed, you're want to get a takeout mortgage at a lower rate. So at that time, you'll switch to another lender, most likely after it's completed, and pay back the construction loan.
The companies you mentioned, I don't think they were construction companies. I think they were cost consultants, right? You mentioned
Yes,
Altus.
cost consultants.
So somebody's asking what were the names again? Pelican, Altus?
Pelican, Altus, Intrepid. Those are the three main well-known ones that every lender accepts. And then whatever they write in their report saying this is the amount of check you cut, and the lender just follows their report and cuts the check for that amount. Because they say this is the cost to complete, this is how much you've already advanced, this is how much you should advance now. That's it.
Okay. All right, very good. So you've got our phone numbers there. And Scylla, regarding your question about the co-ownership, I would suggest that you call either Rena or myself to discuss further. You've noted owned by a family, but I think I would certainly like further details before commenting. Feel free to give me a call on that if you like. And I think that's about it. Rena, any, can we get a recording? I'm not sure this is being recorded, Ali.
It says it's being recorded.
Oh, does it? Okay, so send me an email if you want a recording of this. And then as long as I do have the recording, then I will send it to you. Because on my end, I'm not certain. Yeah, I think it is being recorded. Okay, so we should be able to do that. Send me a note if you want to have it, if you want the recording.
I see Mazir just sent in a message to thank all the panelists. So thank you, Mazir. And thanks to everyone.
Thank you, Mazir.
Especially David.
Rena, thanks a lot. Stay well. Keep on dancing. We want to see some more of your Greek dancing videos on Facebook.
All right.
Yeah. And have an awesome weekend, everybody. I hope it's going to warm up. And we'll see you all soon.
Okay. Bye-bye.
Take care. Bye, everyone. Thanks for joining.